Hi, I'm Brandon Lau with Cheney Brooks Choice Advisors, and I want to provide you some insight into how to deal with the current market. We know that there are headlines which indicate that sales are slowing, interest rates are up, and the economy is heading into recession. So the question is, as a buyer or seller, how do you navigate Hawaii's residential real estate market? Well, the first thing to understand is that yes, headlines do show us what's happening in the current environment, but it's also good to look at the historical aspect of things like our interest rate and prices and how are things faring in regard to the past several decades. Well, if you look at our current interest rate, we have had a sharp increase from roughly 3.25% to 7% where it is right now. And that's from January till November. Now that increase is pretty substantial. In fact, it's been the biggest increase we've had in a couple of decades. But if you look at the historical trend of our 30-year rate, from 1971 until present, the rate on average has been about 7.76%. So historically, we're still at an average rate. However, the rapid increase in rate is what's caused quite a disruption in our market. Now, if you look at the recent stats from the Hawaii Association of Realtors, we see that across the state, there's been a decline in the number of single-family homes and condominium sales. Okay, and that's to be expected, especially when you have such a quick increase in the 30-year interest rate. However, year-to-date, prices have still increased, both for single-family homes and condominiums, and that's no surprise. You know, we have a limited inventory here in Hawaii, and we're always having to try to keep up with population growth, of which there's not enough housing being produced just to keep up with the increase in population. Therefore, we always have a chronic shortage of housing. Okay, so where we are right now, looking at where the stats have indicated, is we are looking at a slowdown in the market due to the decline in the number of sales, which will soon make its way into a softening of prices. Okay, but again, because of limited inventory, we may not see a dramatic decline in the median prices themselves. If you look here just on Oahu, again, in a similar setting, we have a decline in number of sales, but prices have increased both for single-family homes and condominiums. And we see there that single-family homes are being affected earlier than condominiums because of the higher price points. So your days on market is higher by 22%. And also the sold to list price ratio has declined as well. Okay, so again, it really is an affordability issue that we're running into, which is why single-family homes are feeling the brunt of it first. Now, real estate does affect our economy and our households in a very big way. And I just want to show how that looks in terms of the numbers. So when you look at how it affects our economy, according to the National Association of Realtors, if you had one medium home sale in 2021, that would have an effect of $113,000. Okay, and that's when you take into account the income generated from real estate industries, expenditure generated from a home purchase, then there's a multiplier effect, and then of course new home construction. Okay, so that's how it looks nationwide. The question is, what did it look like for the top 10 states? Well, it turns out that Hawaii sits on the very top of that list, with $306,000 being generated from one home sale at the median price. And again, the same areas are accounted for, and the headline to this is that in Hawaii, the real estate industry accounted for $21.5 billion, or 23.9% of the gross state product in 2021. And that is huge. So in Hawaii, real estate plays a big role in impacting our economy. Okay, so whenever you have a disruption due to something like an interest rate increase by 3% in 9-10 months, you're going to have some impact. Now, if you look at the household budget in particular, comparing Honolulu to the rest of the U.S., we see that for housing, food, and personal insurance and pensions, Honolulu has a higher percentage of costs or a higher percentage of contribution from the personal household budget. And if you look at the breakdown, it's pretty surprising, but looking at housing in particular, we have a number of 41.2% of our budget going towards housing in Honolulu, compared with only 34% across the rest of the US. So in Honolulu, we're paying a lot more per household for housing. Okay, so there's been a big impact. Now, if you do the simple math and you take a look at, well, how does that affect our expenditures and how much income we need to make to cover that, you'll have to, as a household, have an increase of income by 15% just to cover the increase in housing cost. Okay, 15%. The question is, which household has had an income increase of 15% in the last 10, 11 months? The answer is probably none of us. Okay, so that's why it's been a pretty significant disruption for home buyers here in Honolulu and the rest of the state. Now let's take a look at a simple scenario where we're comparing a purchase at a 3.5% 30-year fixed rate versus a purchase at a 6.5% 30-year fixed rate. Okay, and let's say it's $1 million purchase, 20% down. When you account for your principal and interest and then monthly tax and insurance, your monthly payment is $3,934 per month, okay, at 3.5%. Now you take that same scenario at 6.5%, your monthly payment increases to $5,398 per month. That is a 37% increase in your monthly payment just because of that 3% increase in interest rate. And that's pretty significant. So, what does that lead to? Well, it leads to a change in the options of our lifestyle, right? So, yes, it's going to affect our household budget, but then it translates to affecting our lifestyle. And in particular, if you're a home buyer, you have these things that could happen in your situation. So, let's say that home buyer, again, we're looking at the same $1 million house at a 3.5% rate, okay? But let's say they didn't have that 50% increase in income, okay? That means their purchasing power at the same monthly payment would decrease to $768,000, okay? And that's going to have an impact in their lifestyle. So the first thing it could impact is maybe the condition or size of their house. So you might go from this house in Liliha, which is a 4-bedroom, 1-bath, just over 1,000 square feet, 4,000 plus square foot lot, which is priced at $848,000, okay, relatively nice looking, to the house on the right, which is a 3-1, slightly smaller interior, slightly smaller lot, but in need of major repair. And that's selling at $685,000, okay? Now, they're very close to one another, in fact, 2 streets over, but because of that change or the difference in condition, there is a difference in price. So you may have to buy something that needs a little more work if you're looking to purchase a home in that area. Now let's look at another alternative, which is property type, okay? So for some home buyers, they may want to stay in the same neighborhood, but we may want to take a half step up into a condominium versus all the way to a single family home. In this case, they may find something that is roughly the same size. They have to account for the maintenance fee, but of course the price point is lower, so it fits their budget, okay? And this is a good option for home buyers in this current market, but again, it does have an impact on lifestyle. Okay, something like that could be in a similar neighborhood. So if you're looking at, say, school district or wanting to be close to work or family, it is possible, but you may have to change your property type. Now, it also may impact the location of where you want to live. Okay, so using similar scenario, instead of buying in Liha, you may want to buy in Waipahu, where you have a similar square footage in interior and lot size, but a lower price, which again is going to be able to fit your budget at the higher rate. Now, you may have to give up maybe an hour of sleep and you have an hour more of drive time, but that is an option for home buyers in today's market. Again, it's a change in our lifestyle to adjust to a change in the rate. Now, knowing that, again, real estate does have an impact in your budget and it has an impact on options for your lifestyle, let's talk about how it impacts our retirement, knowing that real estate is a part of our retirement. Now, this is an example of a balanced portfolio. By no means is this textbook. It's just one potential scenario where you have a decent amount in stocks, a little bit in bonds, and then you have a decent amount in real estate by virtue of the fact you've built equity in your primary residence, or you've even bought maybe an investment property, and then you have cash. Now, for those of you who are real estate heavy, like some realtors, myself included, your portfolio may look something like this, where you have a lot invested in real estate, some stocks, a sliver in bonds, and a little bit in cash. Okay. Now, if you've invested in real estate for the long run, I want you to know you've probably done very well, especially in the recent couple of years. And so real estate does have a good place in somebody's retirement portfolio. Now, these are the 4 key benefits of owning real estate. So there's cash flow, there's appreciation, leverage, and also tax advantages. Okay, but some of these areas have been impacted by, again, this change in the rate. You look at for example, at cash flow. So if you took that same property, which is priced at $850,000, and you had a down payment of 42%, that was a break-even point for this house. Okay. Now, if you take these same numbers, translated it at the higher interest rate, you could have a negative of $921 a month. So it does have an impact on your cash flow as an investor. So something to be aware of if it's in your portfolio. You may want to use cash for the purchase versus relying on leverage or a 30-year fixed rate mortgage in this case. Okay. And when you look at appreciation, this is a beautiful chart because it shows you how single-family homes in red and condominiums in blue have appreciated since 1985. Okay, and it's a staircase-like pattern. Again, because of the limited amount of inventory, we're always going to have appreciation here in Hawaii, and so it's a nice increase over time. Now, the question is, what's going to happen in the coming years? Well, although there's no crystal ball, if things happen historically like they have in the past, we are pretty much at the peak of the median prices. We're going to have a slight softening of the market, waiting for household incomes to catch up with the prices, and then also waiting for rates to stabilize. But at some point, when those two things happen, we're going to again start to see the market turn towards an appreciating market of real estate for both single-family homes and condominiums. Okay, so for people who have real estate in your portfolios, in your retirement planning, you will benefit in the long run from owning real estate. Now, leverage has been affected because, again, the higher rates. So there are alternative avenues that some owners and investors are taking. For example, looking at adjustable rate mortgages is one. Looking at temporary buy-downs, for example, a 2-1 or 1-1 buy-down is another. And also looking to seller financing as an option is what some buyers are doing in this market. Okay, so you can still leverage to purchase real estate, but there are alternatives that you may want to look at, which may be better for your situation. Now, of course, for anything tax-related, please consult a CPA or a tax professional. But some of the great benefits that come along with owning real estate are in the write-offs. So if you have an investment property, you can write off things like your property taxes, your insurance, your mortgage interest, your property management fees, costs of repairs and maintenance. And if you make it a business, you can write off things like your advertising, your business equipment, your legal or accounting fees, or even travel to and from your investment property. Okay, so these are all tax write-offs that benefit owners of a real estate investment. Depreciation is another benefit. Because of the incremental loss of value of an asset like real estate, you can depreciate the improvement portion of your property. Okay, and again, that's decreasing your taxable income. Of course, subject to recapture if you ever sell the property. You also have your pass-through deduction on qualified business income. Now, this has to do with the Tax Cut and Jobs Act of 2017, and it will, at this point, sunset in 2025. But for the meantime, you can deduct up to 20% of qualified business income from your personal taxes. And rental income is qualified business income. Also, we know that long-term capital gains rates are lower than your typical income tax rates, which is why if you have a real estate investment for a year or more, and you sell it, you can benefit from the lower capital gains tax rates versus your income tax rates. And then you have the option as an investor to do a 1031 tax-deferred exchange, whereby allows you to sell your current investment and buy one of equal or greater value to defer paying capital gains tax. And that's a benefit of owning investment property. Now, if you have a primary residence, of course, you do get to take advantage of your homeowner's exclusion from capital gains tax, which is a whopping $250,000 as an individual and $500,000 as a married couple. Again, another great tax benefit of owning real estate. Now, when you look at estate planning, there really hasn't been any impact on the process of estate planning due to the shift in the market. But these are some good things for you to know. And of course, you always want to consult your tax professional on these items. And also your attorney, your estate planning attorney as well. But we're going to quickly dip into trusts, one consideration for title and taxes, and also legacy planning. So as far as trusts go, it's always a good idea that when you're planning for your estate, long-term estate, and if you have real estate, you may want to consider putting that into a trust to avoid probate. Okay, and sometimes probate is a negative thing because number one, you could incur more settlement fees by having to settle your estate through probate. Secondly, you may go through having to advertise your estate publicly if you go through probate. And also, if you go through probate, you may have to go through court approval, which prolongs any sale of your property. Okay, so for these reasons, it's a good idea to look at putting your property into a trust to avoid those things. And of course, this is something you can do via trust attorney. Now, also a little tidbit for us to be aware of is that you can still obtain creditor protection through what they call tenancy by the entirety, which is a benefit for married couples, for spouses, reciprocal beneficiaries, or civil unions. And it affords creditor protection in the case that one party does, let's say, face a bankruptcy or a lawsuit on their business. Well, because a spouse is also on title, that asset will be protected. Okay, and that's called creditor protection. Now, you benefit from this when you take title by tenancy by the entirety. And if you plan to put the property into a trust, remember that you could put it into tenancy by the entirety first and then put it into the trust. So you also have creditor protection. A tax consideration that has to do with estate planning is your step-up in basis. And another tax benefit of owning real estate is that if you own the property and you pass, then the basis for that property steps up to the current market value at the time of your passing. And should your heirs sell the property at that time, there could be zero capital gains at that point. Okay, and that's through a step up in your tax basis of your property. Again, that's something you can consult your CPA and also your estate planning attorney about. A last consideration is there are some people who may not have heirs and they have assets that they're not sure what to deal with after their passing. Well, if they're planning for some sort of legacy to give to charity or some service organization, they may want to consider a charitable remainder trust. And that's a situation where you put your assets into an irrevocable trust, and upon your passing, the assets will be provided to that charity or organization of your choice. But in the meantime, you can be generating income from that trust, okay? And also there are some tax benefits whereby if you sell a property while it's in the trust or CRT, then there are not the same tax consequences as if you sold it in your personal name. Okay, so that's another consideration for legacy planning in terms of your overall estate. Now, the real question for a lot of buyers and sellers is, okay, we know that real estate has had an impact on these areas of our life. So what are some strategies that I can employ right now? Okay, so these are strategies that you as a buyer or seller can employ right now, given today's changing market. Now again, we're not quite sure how things may turn out, but it's a possibility that we're at the top of the market or apex of our values for this cycle. And therefore, we may have a softening in the next few years before things turn around again. So assuming that is the scenario, let's take a look at some of these strategies. If you're a first-time buyer, nothing is stopping you from getting into the market. In fact, why not take advantage of building equity, having those great tax benefits, and position yourself to gain from appreciation when the market does turn around. So there's no benefit to waiting as a first-time buyer, okay? Also, again, consider taking a half step. Rather than going for the home run single-family home, you may want to get into a single condominium first, which is a little more affordable, doesn't put you in a stressful situation, but you can always increase to a single-family home when the market changes or your household income changes, okay? So taking a half step might be a good idea. For move-up buyers, first thing I would recommend is be aggressive. Rather than just waiting on the fence till the market quotes hits the bottom and losing out on building equity, losing out on the tax advantages, be aggressive to find the price and terms right now that you want for your property. Okay, and that's through negotiation. So saying that I'd like you to keep in mind is why wait? Negotiate. Okay, that's what you can do as a move-up buyer in this market. And also be flexible. Know that the 30-year fixed loan is not your only option. Consider an ARM or a buy down or even seller financing to get you through these high interest rate months. For long-term investor buyers, aside from being aggressive and being flexible in your financing, is think 5+ years. Again, we may have to go through a season of softness in the market before things pick up again. So think long-term with your purchase. Don't think, buying now and selling in 3 years, because you're probably not going to benefit from appreciation. But thinking 5+ years will give you that possibility and that advantage of benefiting from the market when it does turn upwards again. If you're a short-term hold buyer, meaning a flipper, aside from being aggressive and being flexible with financing that you may pursue, is think of a 25% minimum margin, meaning buy into the property at a much lower amount than the current market value. And that's to make sure you have sufficient margins to reinvest in the property and then sell it without worrying that you'll be chasing the market. Okay, you don't want to be in a situation where you're losing money off of your short-term investment. Now, as a seller who's purchasing, I would recommend, number one, to sell now. Sell while we know the prices are good. While we know the economy is still decent, we don't know what next year holds. There could be a situation where more of a recessionary mode at that point. rates may not be better. In fact, it may be a little higher if we're still moving that direction. But at least selling now gives you the benefit of knowing what you're going to get. So selling now might be your best option if you're a move-up seller. And also be flexible. Know that you can't ask for everything in negotiations like you could a year ago, but rather you have to work with buyers and their needs. And then thirdly is consider a short-term rental. You don't have to be in a rush to purchase. In fact, it might be to your benefit to take your time, right? So if you get into a short-term rental of 6 months to a year, that'll allow you to sell your property now, and at the same time, make a good decision on what you're going to buy next. And of course, if you're a seller who's downsizing and you're just trying to liquidate your current property, sell now. Now is the time you're going to get the best price, and you have an understanding of values for where they are now. You don't have a understanding of values for it might be next year if the market does soften and we're more in a recessionary situation economically. Okay, and of course, be flexible. Again, it's not the same market it was a year ago. You're gonna have to work with buyers, understand their needs, and try to make it more of a win-win situation. So those are strategies on how to navigate the current change in Hawaii's residential real estate market. If you need more information or you want to hear from one of our advisors, please go to our website or you can give us a call. We'd be more than happy to sit down with you, go over a consultation to understand your needs and goals and see how we can be of service to you. So thank you so much for joining me, and we wish you the best. Aloha.